Download this code from codegive.com, link in the description below. OK, let's dive deep into the world of inflation, how to battle it, Warren Buffett's preferred instruments, T-bills, and the subtle nuances that differentiate them from bonds. This will be a comprehensive guide. Understanding inflation, a comprehensive overview. Inflation, at its core, is a sustained increase in the general price level of goods and services in an economy over a period of time. It reduces the purchasing power of money, meaning each unit of currency buys fewer goods and services. Think of it like this: if a loaf of bread costs $3 today and inflation is 5%, that same loaf of bread will likely cost $3.15 next year. Causes of inflation. Demand pull inflation. This occurs when there is more demand for goods and services than the economy can supply. Think of a hot new product that everyone wants, but the manufacturer can't keep up with the orders. Too much money chasing too few goods. Government stimulus, increased consumer confidence, and rapid economic growth can fuel demand pull inflation. Cost push inflation. This happens when the costs of production for businesses increase. Examples include rising wages, higher energy prices, or increased raw material costs. These costs are often passed on to consumers in the form of higher prices. Supply chain disruptions can be a major driver of cost push inflation. Built-in inflation. This is a self-perpetuating type of inflation. It occurs when workers demand higher wages to keep up with rising prices, and businesses then raise prices to cover the increased labor costs. This creates a wage price spiral. Increased money supply. When the amount of money in circulation increases faster than the economy's output, it can lead to inflation. This is a contentious issue, but many economists believe excessive money printing by central banks can contribute to rising prices. Measuring inflation. Consumer Price Index, CPI, the most widely used measure of inflation. It tracks the average change over time in the prices paid by urban consumers for a basket of consumer goods and services. Different CPI figures exist: CPIU, CPIW, but the CPIU is generally cited. Producer Price Index, PPI, measures the average change over time in the selling prices received by domestic producers for their output. It can be an early indicator of inflationary pressures as it reflects costs at the wholesale level. Personal Consumption Expenditures, PCE, Price Index. The Federal Reserve's preferred inflation measure. It's similar to CPI but uses a broader basket of goods and services and is updated more frequently. GDP Deflator. A measure of the level of prices of all new, domestically produced, final goods and services in an economy. Types of inflation. Creeping inflation. A gradual and relatively mild increase in prices, typically 1 to 3% per year. It's often considered manageable. Walking inflation. A moderate increase in prices, 3 to 10% per year. It can become a concern if it persists. Galloping inflation. A rapid and out of control increase in prices, 10% or more per year. This can be very disruptive to an economy. Hyperinflation. An extreme and very rapid inflation, where prices increase by 50% or more per month. This is a catastrophic scenario that can lead to economic collapse. Deflation. A decrease in the general price level. While it may seem beneficial at first, deflation can be harmful as it discourages spending and investment, leading to economic stagnation. Effects of inflation. Reduced purchasing power. As prices rise, the value of money decreases, meaning people can buy less with the same amount of money. Asterisk erosion of savings. Asterisk inflation reduces the real value of savings over time, especially if interest rates are lower than the inflation rate. Asterisk increased uncertainty. Asterisk high inflation creates uncertainty for businesses and consumers, making it difficult to plan for the future. Asterisk distortion of economic signals. Asterisk inflation can distort price signals, leading to inefficient resource allocation. Asterisk redistribution of wealth. Asterisk inflation can benefit borrowers at the expense of lenders if interest rates don't keep pace with inflation. Asterisk social unrest. Asterisk high inflation can lead to social unrest and political instability. 2. Battling inflation, strategies and tools. Governments and central banks use various tools to combat inflation. Here are the main approaches. Asterisk monetary policy, central bank actions. Asterisk raising interest rates. Asterisk the primary tool. Higher interest rates make it more expensive for businesses and consumers to borrow money. This reduces spending and investment, cooling down the economy and reducing demand pull inflation. The Federal Reserve, in the U.S., uses the federal funds rate as a benchmark. Asterisk reducing the money supply. Asterisk central banks can reduce the money supply through various means, such as selling government bonds, quantitative tightening, or increasing reserve requirements for banks. Asterisk increasing reserve requirements. Asterisk increasing the amount of money banks must hold in reserve reduces the amount available for lending, thereby tightening credit and reducing the money supply. Asterisk fiscal policy, government actions. Asterisk reducing government spending. Asterisk cutting government spending reduces overall demand in the economy. Asterisk increasing taxes. Asterisk higher taxes reduce disposable income, which reduces consumer spending. Asterisk budget surplus. Asterisk running a budget surplus, spending less than revenue, reduces the amount of money injected into the economy. Asterisk supply side policies. Asterisk deregulation. Asterisk reducing regulations can lower the cost of production for businesses, increasing supply and potentially lowering prices. Asterisk tax cuts for businesses. Asterisk similar to deregulation, tax cuts can incentivize businesses to invest and expand production. Asterisk investment in infrastructure. Asterisk improving infrastructure can increase efficiency and reduce transportation costs, leading to lower prices. Asterisk wage and price controls, less common and controversial. Asterisk these are direct government interventions to limit wage and price increases. They are often ineffective in the long run and can lead to shortages and black markets. 3. Warren Buffett's preference, T-bills over bonds in an inflationary environment. Now, let's get to the core of your question. Warren Buffett, a legendary investor, often favors Treasury bills, T-bills, over longer-term bonds during periods of rising inflation or when inflation is expected to rise. Here's why. Asterisk short maturity. Asterisk T-bills have very short maturities, typically ranging from a few weeks to a year. This is their key advantage in an inflationary environment. Because of their short duration, their prices are less sensitive to interest rate changes. As interest rates rise to combat inflation, the value of longer-term bonds can decline significantly. T-bills are less affected. Asterisk lower interest rate risk. Asterisk rising interest rates negatively impact bond prices. The longer the maturity of a bond, the greater its interest rate risk. Since T-bills mature quickly, you can reinvest the proceeds at the new, higher interest rate sooner. Asterisk opportunity cost. Asterisk Buffett understands opportunity cost. If you lock in a low interest rate on a long-term bond, you miss out on the potential to earn higher returns as interest rates rise. T-bills allow you to take advantage of rising rates more frequently. Asterisk liquidity. Asterisk T-bills are highly liquid. You can easily sell them in the secondary market if needed, though you might lose a small amount of principal. Asterisk safety. Asterisk T-bills are backed by the full faith and credit of the U.S. government, making them virtually risk-free in terms of default. Inflation erodes their real return, though. Asterisk inflation protection, indirect. While T-bills don't directly protect against inflation like Treasury inflation-protected securities, TIPS, do, their short maturity allows you to reinvest at higher rates as inflation rises, providing a degree of inflation protection over time. Why not bonds? Asterisk long-term bonds and inflation. Asterisk long-term bonds are negatively correlated with inflation. When inflation rises unexpectedly, interest rates typically rise as well. As interest rates rise, the value of existing bonds decreases to compensate investors for the higher yields available in the market. This means you could lose money if you sell your bonds before maturity. Asterisk fixed income versus inflation. Asterisk bonds offer a fixed income stream. If inflation rises above the bond's coupon rate, the real return adjusted for inflation, becomes negative. This erodes the purchasing power of the bond's income. Asterisk reinvestment risk. Asterisk while longer-term bonds can offer higher initial yields, they expose you to reinvestment risk. If interest rates fall during the bond's term, you'll have to reinvest your coupon payments at lower rates. However, in an inflationary environment, the focus is on rising rates, making T-bills a better choice for quicker reinvestment at higher yields. 4. Code example, illustrating the impact of inflation and rising rates. This Python code demonstrates the potential impact of inflation and rising interest rates on bonds compared to T-bills. Note that this is a simplified model. Explanation of the code asterisk. 1 bond underscore value function asterisk calculates the present value of a bond given its face value, coupon rate, years to maturity, and discount rate, interest rate. This uses the standard present value formula. 2 scenario setup asterisk. Asterisk face underscore value, the PAR value of the bond, what you get back at maturity. Asterisk coupon underscore rate, the annual interest rate paid on the bond. Asterisk years underscore to underscore maturity, the number of years until the bond matures. Asterisk initial underscore interest underscore rate, the starting interest rate, matching the coupon rate for simplicity. Asterisk inflation underscore rates, a list of increasing inflation rates for each year. This simulates a rising inflation environment. Asterisk interest underscore rates, a list of interest rates that increase in response to the rising inflation rates. This mimics how central banks typically react. 3 bond value calculation asterisk. Asterisk the code calculates the bond's value each year, taking into account the current interest rate, discount rate, in that year and the remaining years to maturity. As interest rates rise, the bond's value decreases. 4 T-bill scenario asterisk. Asterisk T underscore bill underscore return, a list to store the cumulative value of reinvesting in T-bills each year. Each year, the previous year's value grows according to the prevailing interest rate for that year. 5 Plotting asterisk the code plots the bond's value and the T-bill value over time, visualizing how the bond loses value as rates rise, while the T-bill benefits from reinvestment at higher rates. It also provides inflation-adjusted values. Important considerations asterisk. Asterisk simplified model asterisk this is a simplified model. In reality, the relationship between inflation, interest rates, and bond prices is more complex and can be influenced by various other factors, economic growth, investor sentiment, etc. Asterisk tax implications asterisk the code doesn't account for taxes, which can significantly impact investment returns. Asterisk real-world T-bill rates. Asterisk the T-bill rates are based on the interest underscore rates list, which is directly tied to the inflation scenario. Real-world T-bill rates will fluctuate based on market conditions and Fed policy. Asterisk inflation-indexed bonds. Tips. A more direct way to protect against inflation is to invest in Treasury inflation-protected securities, TIPS. TIPS are indexed to inflation, so their principal value increases with the CPI. However, Buffett has sometimes expressed reservations about TIPS, particularly when real yields are very low or negative. V. Further points and nuances. Asterisk Buffett's time horizon. Asterisk Buffett typically has a very long-term investment horizon. His preference for T-bills in an inflationary environment is often a short to medium-term strategy. Asterisk alternative investments. Asterisk during periods of inflation, other investments besides T-bills can also provide inflation protection, such as asterisk real estate. Asterisk real estate values tend to rise during inflationary periods. However, real estate is less liquid than T-bills. Asterisk commodities. Asterisk commodities, gold, oil, etc., are often seen as a hedge against inflation. Asterisk inflation-linked bonds, TIPS. Asterisk stocks. Asterisk while stocks are more volatile, they can provide long-term growth and may outpace inflation. Some sectors, like energy and materials, may benefit directly from rising prices. Asterisk the Federal Reserve's role. Asterisk the Federal Reserve plays a crucial role in managing inflation. Its actions, such as raising interest rates or reducing the money supply, can significantly impact the effectiveness of different investment strategies. Asterisk dynamic asset allocation. Asterisk the best approach to battling inflation is often a dynamic one, where you adjust your asset allocation based on the current economic environment and your own risk tolerance and financial goals. In summary, while bonds can be a valuable part of a portfolio, particularly in stable or deflationary environments, T-bills offer a more defensive position when inflation is rising or expected to rise. Their short maturity allows for quicker reinvestment at higher rates, mitigating the negative impact of rising interest rates on fixed income investments. However, it's essential to consider your own investment goals, risk tolerance, and the overall economic outlook when making investment decisions. Don't rely solely on one strategy or asset class. Diversification and a thoughtful, adaptable approach are key to long-term financial success. Buffett's strategies are insightful, but they need to be applied in the context of your own specific situation.